Hi everyone and welcome to the Everyman Investor. So in this week's video, I'll be taking a look at the stock market movements over the past week or so. As you can see, the stock market has been on a sort of roller coaster ride. So let's take a look at what factors have been affecting the stock market and whether or not from the factors that have been affecting the stock market recently, we can predict where the markets will be going next. So let's look at technical analysis first. I know I don't usually do this, but the RSI has been rather indicative of how stock market movement has been moving of late. So over the past week or so, as you can see, the RSI actually reached overbought levels above 70 on two occasions. In fact, it reached nearly 70 after that subsequently as well. But then again, it also reached oversold levels once the sell-off started, which basically contributed to quite a bit of the market volatility. So it's probably a lot of traders taking profits and then buying again as the market corrected, or rather not corrected but dropped, and bought and then sold again. There's been quite a bit of economic data as well that's affected the markets, but in general, the consensus is that the market was a bit overbought over the past week or so, which, as you can see, the technical indicators show that is the case, and profit taking was probably one of the reasons why the market sort of sold off on certain days. Now, the other issue is that this end of the year period is when people will sell stocks at a loss to basically not pay so much tax on capital gains. So it's one of those things that the pros will gain, and it can affect the market volatility over the next few weeks. Okay, so for economic data, quite a bit of data has dropped in the past 2 weeks or so. Now, the most important data is, of course, the PCE, which is basically what the Federal Reserve looks at to determine whether or not it's going to raise rates, cut rates, keep rates the same. Now, the core PCE, which is what is most important for the Fed, the current data, the most recent one, came in at 3.5% inflation versus the previous of 3.7%. Now, the Fed's goal is 2%, which means to say that it's trending downwards very nicely. Question is whether or not this is enough to satisfy the Federal Reserve. Now, as you can see, I put it in green because this is basically bullish for the market. Now, on the other hand, this is GDP for the 4 quarters of 2023. Okay, we've got the first 3 quarters in already, and Q4 is an estimate based on the Atlanta Fed GDP now. The estimate currently is 1.2%, which is the lowest of the whole year so far. If this continues on, it means to say that GDP is slowing significantly. This will not be good for stocks in general. Now, let's look at hourly earnings, which basically will contribute to inflation. It is trending down nicely, which is good, which is bullish again for the stock market. However, the recent jobs data that just dropped today, about half an hour or so ago, actually shows that the job market is still extremely strong, and it is not good. In fact, the futures have dropped quite a bit since the non-farm payrolls was released. The unemployment rate has also dropped, which is again not great because we really want unemployment to be sort of steady. Most people say the neutral rate about 4% or so to provide some disinflation in the sense that people are unemployed, they don't spend so much. Basically PCE comes down and the Federal Reserve is happy. Okay, so what next? Now let's see whether or not we can see into the future. So, the best case scenario will be that inflation cools and the employment stays strong, and the bull market is going to carry on strong over the next 6 months to a year or so. Now, if inflation cools but employment weakens, then this is where things are on a knife edge. It can tip either way depending on how the employment market goes. And of course, the bearish scenario will be if inflation cools but the employment collapses because of the inflation cooling from the increased rates from the Federal Reserve, and that will probably lead to a recession. Now, as we can see, big companies have been cutting jobs like crazy. If you've been following the news on CNBC, basically just about every big company has been cutting jobs over the year. The most recent one was Spotify, which cut about 17% of its workforce. It actually did the shares very good. In fact, when companies cut jobs, the shares usually go up because they cut basically their expenditure, so their earnings would increase conversely. So what is bad for the employment market is actually very good for stocks because it will deter the Fed from raising rates. In fact, it might even prompt the Fed to cut rates, and also it helps companies to be more profitable. Now, what about the Federal Reserve? There's been a lot of Fed commentary over the past 2 weeks. So, among the commentary are rates are not high enough, which is basically bad for the markets. Rates are high enough, but there's no rate cuts being discussed, which came from the chairman himself. And this is basically neutral if rates stay currently as they are. And then there's Fed officials that are talking about rates being high enough and rate cuts are possible. Now, in summary, the Federal Reserve doesn't have a clue. In the same way they missed the so-called transitory inflation, there doesn't seem to be any agreement about whether or not rates are high enough yet. Okay, so what next? Next week is going to be a nail-biter because there's going to be core CPI, there's going to be core PPI, and this is going to come in just before the FOMC interest rate decision, which will tell us whether or not the Fed is going to raise rates, cut rates, or keep rates the same. Now, at the moment in time, the overall general consensus by overwhelming majority is that rates are going to stay the same. They are not going to go up or down. But at the same time, the Fed will be releasing their latest dot plot. I'll go into details of the dot plot when it's released next week. Basically, it's the guidance for the Fed's rates expectations over the next year. It is updated every quarterly, so it is valid until March next year. The thing about the situation now is that the futures markets actually expect rate cuts in first half of next year. In fact, some people are expecting rate cuts as early as January or February, which to me seems unrealistic given that the PCE is still way above 2%. Now, if the Fed disappoints and basically does not indicate any rate cuts at all, the markets are probably going to have a fit. So, I'm afraid I can't give you any clear direction about where it's going to go. But the thing is, next week will be a week which will probably tell us where the market will be moving over the next 2 to 3 months until the next dot plot. And from there, if the Fed indicates any rate cuts, the market is probably in the clear for a while, at least, unless more job cuts happen, and then things go back to being somewhat shaky. So thank you for watching. I hope this was informative, and I'll update you again next week when the Federal Reserve meeting is concluded and they have come up with their sort of interest rate decisions, as well as when the dot plot is released. And I will go through the dot plot and why it's very important for us as investors to know how to interpret that. So thank you for watching, and I'll see you in my next video.